Well, all week the risk dial swung up and down and up and down and finally finished down. This is what tells me that next week we're going to see some pressure, probably not excessive, but we're still in risk off in every single measurement, as you can see. 30, 28, 14, 14, minus 6. So we are still in risk off. There is still no reason to chase this market. Any trend is a weak trend, and the dips can be bought. I think all the way down. We'll see deviations in a moment around the 29.50 area. So minus 6, 32, minus 6. This is the kind of thing that really is a nightmare for any model. But fortunately, we have deviation. And here we are. Can you exclude a dip back to the central line, which is just above around 29.50? No, you definitely can't. Is it likely? Well, I think there's a more than a 50-50 chance of that happening, but I think at that level you definitely want to be buying some call spreads. If we look at what the other sectors are doing, XLE is still not turning up decidedly. It could have done a lot better this week. It didn't. You have the telecoms, which could have done a lot better, didn't. XLU is still in a bull phase, isn't it amazing? XLU is still doing exceedingly well. And then you have sectors like XLB, which are turning, it seems, and XLK is the one that is just so uninspiring. I think any move down in XLK towards the middle line around 80, you can give it a little go, but it's just so uninspiring. I would leave it alone. And the financial sector is the one that seems to be turning for a bit and coming down. But I would have thought any dip anywhere near the 27.50 area to me is a buy. So really uninspiring. I think Powell has done his job well. He's sent us to sleep. I think it'll be an orderly trading market in a 2-3% range in the index for the foreseeable future. As to the Blue Angels, absolutely nothing is changing, is it? We have no change in trend. So basically any dips will be bought. I don't think we will retest the times 16, simply because I don't think the yield of the 10s and 30s is going to move enough to justify it. And therefore, the multiple expansion will just slowly go on, because there is no alternative at the moment that I can see to it. The most important piece of data to look at the moment is basically the yield of the market compared to the bonds. And while it's strong and decidedly above the bond yield, and the bond yield doesn't move, I think the volatility in equities is going to remain pretty low too. Well, I think the bonds are going to be fairly stable. Any move down here to minus 162, 163 is going to be a buy. And really you're looking for no higher than around here, 182, 183. It's unlikely that we get out of this range for quite some time. I would have thought several weeks in a 20 basis point range is going to be, even a 20 basis points range is probably too much. Volatility in bonds is going to come down. In fives, I see no reason why the market should not do here what it has done here. Basically trade between, let's call it 150 and 177. 25 basis points, and I think even that is too much. So volatility in bonds, yours. 10-year, well, we managed to pick almost the top. And really, let's go sideways. If we just turn this into a weekly chart, we can see that at this level, I really wouldn't be surprised if we did something like this, something like this. You know, it really, I think the yield curve can possibly steepen a little bit. Uh, just under 2 to 170, a 25 basis point range for several weeks here in the 10-year, while everything, these moving averages, etc., catch up. I really see no reason why we should all of a sudden look for lower yields, and certainly any backup in yields is going to be well contained and well bid. And that is another reason why the equities cannot really be that volatile, because there is no reason that we can see at the moment. Naturally, if facts change, we will change our mind, but for the time being, several weeks of sideways is favored. For the first time in a long time, I'm actually showing you a Bund chart, because finally we have a predefined range, and also we have a technical reason to do something if we see a level. The ECB has told us what it's going to do. There aren't many bunds about. In fact, probably the ECB owns them all. So really between -40 and -63 really now is our range. If we see it anywhere near the -40, and let's hope so, that will be our opportunity to front run the ECB and their purchases with a reasonable stop level. So I definitely think that we will go and revisit over the course of the next month this -63 level in bunds, simply because I don't think there are any bunds there, and technically the bund will outperform in Germany. Not much has changed here. -245 to me is still the very key level. I think that we are, likely to revisit it, simply because I think the bunds are going to be so strong relative to everything, because of the QE that is going to be done by the ECB. So maybe I will a retest of the -245 level, but not much really. I think we are, we're not in a trend period like we were here. We are now in a range period, and -245 is probably the worst that I can see. If we go through that, there's something going on and we can revisit it, but -245 should easily cap it. The very, very, very annoying and it's the Euro USD is just not giving us any satisfaction on the downside, even though it keeps on closing below the 111.08 level that is so important. And now we even have the top of the Bollinger. There's nothing holding this market up that I can see. I think the central banks are playing with us, but until we start breaking 111.08 and then go to the 200-day moving average and start breaking that, there's absolutely no reason to own it, none whatsoever. The ECB is going to be doing quantitative easing. We've got 20 billion a month. We've got a bund, which there aren't any bunds. Nobody owns bunds apart from the ECB, and they need to buy them because of the capital key. So I think spreads between the States and Germany will go back out towards that 245 area, as I just said. And if that happens, I really do see a breakdown again in Euro USD. Is there anything different in DXY? No, I mean, it's holding very well above this highest range level, 97.87. It bounces off there every time. It's holding the trend line, but zero impulsion. So let's keep with it because there's no reason to go the other way. Absolutely none. I don't see a better currency there than the dollar, and therefore I don't see any reason to abandon the position. Well, last week I said that gold would be the one thing that I wouldn't be buying on the open. And I was right all week until the close of Friday. I'm beginning to like gold again. I really did think that we would test this 1460 area, but it's just too strong. I'm being impressed by how it has not stayed below 1500, and really the odds now are that we go to the top of this range towards the 1550, 1560 area. If we change this to my favorite short term, which is the 300-minute bar, we will see how this 200 period moving average has just held it beautifully. And that to me means that slowly we should be starting to go up. It's turned all these averages. To me, this is a market we can start being bullish of again because we have a very good stop on a close here. Anywhere close below 1493, 1492, you're wrong and you're out. So a decent risk reward in gold. Nothing much fundamentally has changed for gold. It is still in a bull phase, and therefore you got to give it the benefit of the doubt. Well, oil actually did precisely what the Bollinger Band said. It went up to 62.75, failed there, came back. It still needs a little bit of time, but as long as it doesn't break this 53.55 area, I think it's beginning to look bullish. And it could easily start turning in 2 or 3 weeks' time and be on its way up to 70, 75, 80 without any problems whatsoever, which will be bearish for bonds and good for equities and will be in risk on. So yes, not too shabby. I'm not a seller of oil. Before we do the equities, I wanted to show you a chart of the S&P against the EWJ, which is the Japanese ETF. As you can see, it closed today, Friday, right just next to the very steeply upward sloping 200-day moving average. So really what I would hope to see is a couple of weeks of upwards to sideways, staying below the 50-day moving average, and then a breakdown. Why? Simply because I think that as the presidential race hots up and the numbers come in for someone like Warren over someone like Biden, the market is going to start sitting up and taking notice. Now, is that going to be in a month's time or is it going to be in 3 months' time? Who can tell? But I think a lot of forward-looking people will start shifting some assets out of equities in the States just in case. They might do 5%, they might do 10%, one of those just in case kind of jobs, and I am one of them. If I lose some money, so be it, but if God forbid, Biden loses to someone like Pocahontas, and she starts getting some really good numbers ahead of Trump, you won't see this for dust. This will be down here so quick it won't be true. Now, having worried you about US equities, I'm going to tell you that there really is nothing to worry about for the next week. I think if we get to even the 29.54 area, we will be lucky. All I got to do is really enlarge this chart and show you how all the support of the moving averages comes in at that level. Now, we did have a bad close on Friday, but we're still at this moving average. It's nothing, it's so sideways. exactly what the risk dial is saying. So any kind of dip over the next 2 or 3 days down to 29.64, or possibly to fill a bit of this gap down to 29.50, is going to be well bought, I think. Only a close below 29.50 would give me any kind of room to worry. It's just really as simple as that. On the weekly, really a very, very inside week. More or less, we closed where we opened. Total indecision. 29.52 is going to be an important level. This, 29.50 to 45, whatever. This is where all these highs here were, and then we busted through, and I said do not resist it, and we went another 50, 60, 70 points. Now if we go back through, I think we will go straight down to 29.10, but I really don't see it, because we really need to take out 29.50, and I think that's going to be very, very good support for the whole of next week. The only reason why I'm even entertaining a move down to 29.50 at some stage next week is because NQ is just spent, isn't it? It was the leader. Whenever you wanted to buy equities, you went and bought NQ. It hasn't been that case ever since June, July. So to me, NQ, while it's not a leader, it's very difficult to get bullish, outright bullish, and start chasing prices on a rip in the stock market. It's just not happening. To me, this level here is going to be very important, 7,800 or just below. If we start breaking there, then I would expect even the S&P to be in trouble, because then if we break through there, we really have very little support to about this area, which is the 76.44. And when we are trading here, I certainly expect SPX to be at the 29.50. Well, is this a chart that looks like it's about to explode? No, it really doesn't. 16.25 is going to be the very important area. If we can get through there, then yes, we can get some impulsion and go to near the 1950 area. But while we're below it, and I'm afraid that we'll stay below it. We might have little, bouts through it. Fill these gaps here around 1722, and that would be equivalent to going into 29.50, 55. But then I think you sell it again. You've got a downward sloping 200-day moving average. Nothing really here to write home about to say that this is about to start going ballistic on the upside. My favorite is back down and then trade down to this 11.40-50 area, whatever it is. That makes more sense to me than start going up straight away. The Fed is going to be on hold for a protracted period of time. Yes, of course, we need to stop some people out of their longs, otherwise we haven't got the fuel to go up. But I think it's going to be a little bit of a damp squid for the next couple of weeks. Well, the one market that I was most afraid for last week, which was Germany, because the effect on auto stocks from higher oil prices and all that actually didn't do a thing. You can see how well the blue moving average held the price every time it dipped there. So really, if we're going to see any kind of move down in DAX, we have to take out 12,340 and close well below it, and then we have room to come down another 200-300 points without any problem. But until we see that, I'm just not willing to short it. I'd rather short the momentum rather than a swing up here, because it's just the risk reward just doesn't look all that compelling. And if the market that could be or should be doing the worst is really holding up and basically going sideways, I don't see why S&Ps should collapse either. And on to the biases for next week. I've put here the 2s, 5s and 10s. I didn't tell you about the bunds. I'll put in the bunds as well. I think the bunds are going to be interesting at between minus 40 and minus 63. That's where we want to see them. And really, if we see the minus 40 area, we really want to be buyers there. It's going to be a gift, I'm sure. We can do a lot of options at minus 40. Now for the SPX 29.52, as long as it keeps on closing above there, I don't think we have a problem in any respect. But you know, this is the one that I'm worried about. The NQ 7782, 7800 is huge support. If we close under there, I think NQ is going to drag everything with it, and that is what I'm afraid of. IUT I'm still not very worried about, because now it should be one of the best indices. I didn't listen to myself because I was unsure last weekend, and really I could have made money much more easily than I did. Never mind, you live and learn, even at my age. VX, I'm really not worried. I think that kind of 1560 to 1625 really should hold for a while. But if NQ gives away, that could cause the spike up. But this 1920 level I really love to sell. Okay, so I'm reminding you, put it in there, get an alarm, whatever. DAX, it should fare worse than stocks. So if you want a safe spread, short DAX, long stocks should be decent, should have very little downside. But unless the DAX breaks this 12,330, I don't think there's anything doing for the US on the downside either. And for the dollar, well, it should be strong. It's doing nothing wrong, and that's why I keep on being patient. 111.08 is going to be the level that it doesn't have to break through. But if it does break through it, I think we're going to have a surprise 1.5%, move up to the 200-day moving average in a hurry. And that could be the surprise and probably the chance to resell it. So definitely, if it starts breaking 111.08, I'm a buyer all the way up to 112.40.50. And the equivalent level of that is 97.20 in DXY. But hopefully, because the bonds should be quiet, I think the market overall can be quiet too next week. Thank you very much indeed, and tweet you on Monday.